Lesson 3, Equity Management. Before we get started, I would like to ask you to read the information on this page. And then I would like to point out that on the center bottom of each page, if you look at the cursor, there is a number. That number represents the number slide that we're on. You can match that number with the number in your workbook. If you get lost, just look at the presentation and match that number with the number in your workbook, and then you'll be up where we're at. Another thing is, during this lesson and other lessons, you'll see this sign. It's called Important Information. Whenever you see that sign, please pay attention to the information on that page. I have placed on those pages traders' tips and very valuable information that I don't want you to forget as you trade. You will probably end up memorizing that information and have that become a part of your trading style and technique. It is there for your success. There are 16 lessons on trading the Forex to help you. These lessons focus in on technical analysis and on trading. These lessons are applicable to all other markets. This lesson is focused in on equity management and survival. I'd like to start out by saying successful traders will do what unsuccessful traders can't and won't do. An uneducated trader cannot do what an educated trader can do. You owe it to yourself, your family, your posterity to properly educate yourself about how the market works before you get involved in the market. I say educate yourself on how the market works or don't trade. There is a 21-day 3% rule. Basically what it's saying is that the human mind forgets 80% of the knowledge it acquires within 3 days. Over the next 18 days, it continues the loss of information until it settles at retaining only 3% of the original acquired information, which means this: if you don't use it, you lose it. If you listen to this presentation and this lesson within 3 days, you will have forgotten 80% of that information. So please play this over and over again until it becomes a part of your trading style and technique. If you don't use it, you will lose it. By the end of this lesson, you will learn to find a high and a low. You will learn to find support and resistance. You will learn where to place your protective stop-loss orders and financially protect yourself in every trade you execute. You will learn to cancel and replace on a trade. You will learn to manage your equity management between 5 and 10%. That's all you should risk on any trade. And you will learn to help yourself from getting emotional and create a trading plan and trade that plan. You will learn to never trade with a protective stop. Now, hopefully, you will learn these things because this lesson is very critical to your financial survival. Before we get started also, I would like to review reading trading charts and placing orders. Most beginner traders work off of Japanese candlesticks. They are very user-friendly and easy to see with the eye. Usually hollow ones are bullish candles. Filled in ones are bearish candles. They are monitoring the open, the high, the low, and the close of any time period. If you look at this chart, the white candles represent the bulls or a bullish environment, meaning prices are going up, and the black ones represent bearish candles. That means prices are going down. Bullish, bearish, bullish, bearish. They're, once again, user-friendly to the eye. You can use line charts in trading. You can use bar charts in trading. Japanese candlesticks just seem to be a little more on the user-friendly side and visually more acceptable. All charts that we will be using are bid charts. They will display the bid price. If you look up in the top, that'll be the current price, which means that is where the price is currently. Most traders work off of bid charts instead of ask charts. There is the bid and the ask. So this is monitoring the bid price. The ask price will look identical to it depending on the spread of the product you are trading. In currencies, spreads are 3 to 10 pips. A ask price chart will look identical to this one. It'll just be a few pips higher. So we buy on the ask and we sell on the bid. So as you trade, whenever you're buying, all you need to do is look at the ask price, and that's the price you'll get. When you're selling, you'll need to look at the bid price, and that's the price you'll get. If you were to enter the market at the market and you were buying, you would be buying on the ask. So here's the current price, 107.30. That is the bid. If there is a 5 pip spread, the ask price would be 107.35. If you placed a protective loss stop, since you bought, it's a sell. You sell on the bid, as well as your limit will be a bid. We sell on the bid and buy on the ask. Conversely, if you're selling into a market, shorting the market, you sell on the bid, that would be the price you would be getting. Your protective loss stop orders would be buy stops, and you would be buying on the ask, which means if the candle rallied up here, the ask price would hit your stop order before the bid price would, which means the candle does not have to necessarily get to that price and you would be stopped out. So please pay attention to that. Once again, we buy, our buy limit will be on the ask. Type of orders, market orders, that's an order placed to enter and exit the market at the market price, whatever the bid and ask is going for, that's a market order. A limit order is an order placed to enter or exit the market at the exact place price or better with no slippage. And a stop order is an order placed to enter or exit the market at an exact price that turns into a market order when touched. Rules to entering the market: if you're ever going to enter the market, any type of order you place above the market will have a name to it. When you buy above the market, it's a stop order. When you sell above the market, it's a limit order. When you buy below the market, it's a limit order. When you sell below the market, it's a stop order. Once again, here's the market. If you placed an order anywhere up here above the market, that would be called an open order or an unfilled order or a working order. Anywhere above, wherever the market is, where you will have to make a decision to either buy or sell above the market. If you buy above the market, it's a stop order. If you sell above the market, it's a limit order. Conversely, any order placed below wherever the market is, that would be an unfilled order, a working order, an open order. Whenever you buy below the market, that's called a limit order. When you sell below the market, that's called a stop order. Those are the rules of trading, just as if we were playing chess and I was pointing out the rules of chess. These are the rules in trading. Here's some additional rules that I think you should try very hard to abide by. Every buy should have 2 sells. One sell for profit and one sell for a potential loss. If you, after quantifying your loss, if you cannot afford the loss, you should not trade. Meaning, look at how the market was trending down here. The market breaks the trend line, enters into the buy zone, which is less than 6. As soon as you enter the market on a buy, remember we buy on the ask and we sell on the bid, you would place a stop order for potential loss at the last low. You would also create a sell order for profit. This then becomes profit. The trading the buy and sell zone is very, very profitable, so I highly recommend that you listen to lesson 6. Ordering rules for selling: whenever you sell and you're a bear you want the market to dip, go down, you should have 2 buy orders, one for profit and one for loss. Once again, let's look at a chart. Market was trending up, market breaks the trend line, enters into the sell zone. You short the market right here. You then place a protective stop loss order at the last high. We sell on the bid, buy on the ask. As the market falls, we place a limit order for profit to get out. Unless you wanted to cancel or replace, you could be chasing this. Trading currencies can be extremely profitable. Order execution procedures, OCO, one cancels the other. After you enter into the market, you place a limit for profit order and a protective loss stop order. And when the market hits either your limit or your stop order, it will cancel the opposing order. A cancel replace is nothing more than an order that is placed. After you place that order and you desire to cancel it and replace it with a new order, that is what a cancel replace is. Let's look here quickly again at an OCO. If we are buying here for whatever reason, we want to use an indicator. We have a lesson 4 is trading indicators. Whenever you focus in on indicator trading and you get a signal to buy, you then place a protective stop loss order here and a limit order for profit there. These are both sell orders. Sell for profit, sell for a loss. OCO means whichever the market hits first. If the market hits your limit order first, it'll cancel this one. If it hits the stop order first, it'll cancel the opposing order. Either way, you can set it and forget it. You do not have to sit in front of your computer and watch this. Cancel replace, locking in profits. I highly recommend that you clearly understand how to cancel and replace. This lesson is going to focus in on canceling and replacing, but whenever you enter the market and chase the market in an educated fashion, meaning once you have found a trade, you enter buying or selling. You then place a protective stop loss order as the market starts to rally and continue to move in your direction. As it continues to move, you cancel your stop and replace it to your entry, therefore placing yourself hopefully into a break even. As it continues to rally and wave and move, you stay behind it, canceling and replacing, locking in profit. Look at how I cancel and replace and stay behind the movement of the market. You'll learn a lot about price swings in lesson 7, which focuses in on the price swing and the Fibonacci. It teaches you all about these waves. Canceling and replacing is all about finding a trade. Once you find a trade, you can see that the market waves. As it waves and achieves a new high, you will then move your order to the last low. See how the market made a new high? Then it waved back and it U-turns and it's starting to make a new high. Now we cancel, replace it to here. As it's made a new high, you have to give it time to come back. As it comes back and bounces, now is the time right here that you will cancel, replace your order from here to here. It then retraces, comes back. As it retraces, U-turns and rallies again. Look at how it's making a new high, taking out the previous high. You can then cancel, replace your stop from here to here. Let it continue to rally, form a high, retrace back. As it retraces back, bounces, wait until it takes out the previous high, and cancel and replace here, locking in profit along the way. You can keep trading on a cancel and replace, locking in profit until you're stopped out. The market's not going to go to the moon as much as you may want it to. It will eventually start to come back down. As it comes back down, it will hit your last order. You will have locked in all the profit from here to here. People that purchase stocks, those that purchased AOL, Yahoo, all these tech stocks, had they properly canceled and replaced, when the market decided to fall back down, they would have gotten out of the market, capturing all the profit from their entry here to their exit up here. They would have locked in all this profit, so that as the market came all the way back down, they would not have had to sit there and watch the market take away all their profit. Remember, only cancel in place to the new last low after the market has made a new high. Conversely, same rule applies. Only cancel in place to the new last high after the market has made a new low. Now, if you enter here, look at how the market just took out the new low. It then began to wave. Now that it's waved and it's taken out this low, you can cancel replace your stop from here to here as it took out this low. Now that it's waved here, you can cancel replace from here to here. Look at it, it's finally stopped, rallied a little bit, U-turned. Now it's in the process of making a new low. Once it has taken out the old low, you can cancel replace from here to here and do that all the way down until it makes you the type of money you're looking for and or stops you out. So please refer to lesson 16 on trading strategies. It'll teach you how to maximize your profits. Remember, as you establish a relationship with the broker, he will give you a right to be a bull, which means you get to buy first and sell second. Bulls are entering the market based on indicators. This indicator is giving several buys and sells. As a bull, you want to buy low, sell high, buy low, sell high, buy low, sell high. Broker also gives you a right to be a bear. That's why a lot of people enjoy trading currencies, because there are no special rules and regulations in shorting the market. A bear sells first. A bear is anticipating the market to dip or go down. A bear wants to sell first and buy second. Even though a bear is anticipating a dip, a reaction, or the market falling down, they will enter selling first and come out buying. Lesson 1 goes into teaching you all about shorting the market. If you have difficulty in learning how to short the market, please give us a call here at Market Traders or Forex Tips, and we will walk you through and help you understand how to properly short the market. You may also want to refer to the at the back of your manual. It goes into detail and explains what shorting the market is all about. Be that as it may, even though you sell first and buy second, if you really look at it, you are buying low and selling high. You sold first and bought second, but you still bought low and sold high. Shorting the market is all about making a profit, even though the market is going down. Perhaps in numerical value, it is allowing you to profit from that. Technical traders learn to read charts. That's what this is all about. Technical traders read charts like doctors read x-rays. To the trained eye, charts are telling a story. Technical analysis gives traders a high probability of knowing where the market is going. A chart is a chart is a chart. Once you learn technical analysis, it will participate greatly in helping you control your financial future. You will no longer be subject to hot tips or broker recommendations. You yourself can start to tell the broker what he or she should be doing. Technical analysis really does give you an edge. So let's get started with Lesson 3, Equity Management. The reality of trading is this. 90% of all traders, novice, get involved in the market will end up failing. And only 10% will succeed or make it. Which really equates to, for every 9 who lose, regardless of what walk of life you come from, only 10% will win. Which means if 90% are losing, the payout for the 10% has to be awfully good. It would be well worth some time understanding and educating yourself why the 10% are going to succeed. Now, just a quick question. Why do you think the 10% succeed? Well, I believe it has to be knowledge-based. One has to acquire the knowledge before they're going to be successful at anything. If you wanted to become a doctor, I highly recommend you go educate yourself before you start practicing. Otherwise, you're going to commit some sort of career suicide as you operate on your first patient. Knowledge gives people an edge in whatever field they're working in. In the trading arena, knowledge combined with experience really gives a trader an edge, and if the odds are 90% of all novice traders fail to educate themselves, they end up paying the 10%. Now, the objective of trading is to make a profit, and we make a profit in this business by buying low and selling high. Trading on the Forex is a zero-sum game. Losers pay winners. If you've ever played poker, that's a great example of losers paying winners. Furthermore, the amount lost equals the amount gained. If you think of the poker game, all the money that was lost goes to the winner. That amount lost equals the amount gained. Now, if 90% are losing, and this is a zero-sum game, that means that there's a huge payoff for the 10% winners. The type of orders that you're going to be, or the type of traders that exist in the market are day traders. They're individuals that get in the market during the day and get out during the day. In the stock market, you will get in during the day and out that same day. On the Forex, the day begins at 3 p.m. and it goes all the way till 3 p.m. with most brokers Eastern Standard Time, which means you enter the market at 6 o'clock at night time and get out at 10 o'clock that night. You are a day trader. If you enter the market at 10 in the morning and get out at noon, you're a day trader. If you enter the market at 4 o'clock in the afternoon and get out at 2 o'clock the next day, you are a day trader. Even though you were in overnight, that's considered day trading on the Forex. The other type of trader is what's called a position or overnight trader. That's an individual that takes a position, buys or sells today, and enters the market as a bull or a bear today, and they stay in for perhaps one solid day. They stay in until tomorrow, the next day, for 2 days, for 2 weeks, 2 months, 2 years. Warren Buffett purchased stock 40 years ago. He is a position or an overnight trader. He's still in. Before you ever execute a trade, you need to decide to either be a day trader or be a position or overnight trader. This is very important. It plays a big part in your strategy. As you're creating your trading plan, create a timeline as to how long you will stay in that trade or want to stay in that trade. Be clear with that decision. Do not vacillate. Managing your risk. Whenever we get into the market, you really can never quantify how much money you can make in a trade. The people that bought some of these tech stocks for $1 a share, $2 a share, and watched that tech stock rally and split and rally and split and rally and split and eventually go from $2 to $300 a share, they really never could quantify how much they could make in a trade. But every one of us can quantify how much we're willing to risk or lose on a given trade. Before you trade, quantify that risk. Say to yourself, I'm willing to risk this much on this trade. And do not risk your entire financial portfolio on a single trade. It's not worth it. You should risk no more than 3 to 10% of your margin account on any given trade. If the risk is too great and the reward is not there, then pass on the trade. Believe me, in the stock market, there are 40,000 different stocks to choose from. There's no such thing as a lotto trade. This isn't, hey, Martha, let's sell the farm. This is not about that. You can always pick another stock, one of 40,000. That's not the only one that's going to move. In the currency market, there's several different currencies, 6 major currencies that you can choose. There's always a trading opportunity out there. So don't think this is it. I've got to do this one.